Welcome to the Probate Nation. Our goal each time you visit our show is to inform, highlight, and educate you about the issues, challenges, and pitfalls you may face, whether you have assumed the ongoing responsibility in a living probate of managing the finances and care of an aging adult as a conservator and guardian, or you are probating the estate of a loved one who has passed away. Our show today continues our conversation on the probate of an estate of a loved one. When someone passes away, probate of an estate is the process to transfer the title or ownership of probate assets to the beneficiary of the decedent. Not all assets are probate assets, and there are different types of probate, some simple, others more complicated. Like a journey on a slow-moving steam engine train, probate of an estate has a beginning, several stops along the way, and at the end of the trip, the balance of the probate assets remaining are delivered to the decedent's beneficiaries. Some probate train rides are short, while other probates seem to never end. Today's show focuses on a stop you need to make along that probate train ride to deal with the tax man, and a topic that causes the eyes of many folks to glaze over, namely income taxes. In an estate, income taxes do need to be addressed. There is the final income tax return of the decedent, which the executor must get filed, and there is also the income tax return or returns for the estate itself that must be filed, and these are called a fiduciary income tax return. These returns, the final 1040 and the 1041 fiduciary returns, offer challenges, pitfalls, and planning opportunities that fall outside the normal personal income tax returns that many folks have done by their local CPA, or that they may do themselves with off-the-shelf tax preparation software. Our guest is a local CPA with experience helping executors sort through this minefield, helping them make good choices and keep the probate train moving along. With us today is the managing partner of Fry & Company CPA. Prior to his appointment as the managing partner, he was the firm's audit partner in charge of the firm's attest practice. He has been a CPA for over 22 years, specializing in and providing accounting, tax, and advisory services to businesses, estates, and individuals throughout Metro DC. Please welcome CPA Mark Fry. Hi, Mark.
Hey, good to be here.
Oh, it's a pleasure to have you. It's nice to see you other than, talking about a tax return of our own.
Absolutely.
So, well, the first thing that comes to mind, as I mentioned, is we have this, someone dies in the course of the year and they have a personal income tax return that has not yet been filed. So, that's my first question, though, is when someone passes away, do they have to file that final tax return?
Oh, of course.
Okay, so there's a final 1040 that has to be filed.
Absolutely.
Okay, so we don't want to forget about that. Now in order to do that, I guess the next question is, what is their tax year? Okay, so can you talk a little bit about that from a final 1040 return?
Absolutely. On an individual's final tax return, the calendar year will be the tax year. However, there's going to be income that's got to be apportioned between through the date of death. But generally speaking, the tax year will still be the calendar year.
But from their standpoint, their calendar year for the personal 1040 ends on the date of death,
yes.
Right? So
yes.
From an allocation standpoint,
yes.
that's where we stop. If this decedent is married and is filing a joint tax return in that filing year, what is the tax year for the surviving spouse, or what period we measure the surviving spouse's income?
It would still be on the calendar year.
Okay.
And the income associated with the decedent would be through the date of death.
Okay. So we do that. Now let's talk about filing status for the decedent. Is there any special filing status for the decedent's final tax return?
Yeah, I mean, all of the filing statuses typically applicable to a taxpayer would be applicable to the decedent for the year of death.
Okay.
The surviving spouse has the ability to continue to file whatever filing status is most beneficial, and there's also a qualifying widower status where they can continue to claim the joint tax filing tax brackets if they have dependents for a period of 2 years.
Okay, so the key thing here is that if we're married, that we still get to keep that joint filing status, which is very helpful.
Absolutely.
And then if we happen to have a dependent, we might be able to continue to keep that benefit.
Absolutely.
What's called the qualifying widower status.
Yes.
Okay. Good. Now this comes up, and we're going to ask this question a couple different times. Okay. Someone's died. We pay all these funeral expenses. and people just wanted to deduct that on the tax return. Okay, so can funeral expenses be deducted on the final 1040 tax return?
No. Not in
Daggone it.
and not in the fiduciary return either,
Oh,
unfortunately.
well, I'll have to ask that one again later. But so the message there is that they can. Where do they get deducted? Just as a matter of curiosity.
Well, from the overall estate, from the value of the assets, the funeral expenses can be deducted.
So if we were filing a federal estate tax return,
Absolutely.
not an income tax return. Well, let's turn to the fiduciary income tax return. So we've filed the final 1040 tax return, but now we have to talk about the fiduciary, because the estate has its own tax return and its own tax year and its own tax obligations. Now, the fiduciary income tax return for an estate is reflected on a Form 1041, IRS Form 1041 for folks in our audience. So we've already talked about the decedent's tax year ends, at least for reporting income, while it's calendar year, it ends as far as the date of death. So when does the tax year for an estate begin?
Well, the estate's tax returns begins on the date of death.
Okay.
Now, there is some flexibility as to the tax filing period or the calendar or fiscal year, but the date of death is the line of demarcation, if you will.
So we start with the date. So if someone was to pass away on June 15th of this year, what are our options as far as a tax year for the estate?
You can select any period within the 12 months from the date of death. So the farthest you could be would be May 31st could be your fiscal year in that illustration.
Okay.
You can also select the calendar year, taking a consideration of the assets that are at play, and all the other factors and tax filing requirements, and also your accounting filing requirements with through probate and so forth.
Okay, so we have that option, then, but in this option, now, when does an estate have to make the decision and elect its tax year?
Well, we typically, at the date of death, you're going to need to obtain an employer identification number, what we call an EIN.
Right.
And so when you obtain that, you generally need to elect what tax period you want when you obtain that EIN. Certain assets will need to be moved over under the title and name of the estate.
Right. So it's when we file and get that federal employee
Yes.
identification number. Now, if it turns out you picked 1 year during that time period and you're filing the first tax return, you still have some flexibility there?
Yes, yeah.
Okay, okay. Now, can an estate forfeit the right to pick a fiscal year?
Yes, I mean, if you don't make any election, the IRS has default rules, and as with anything, they default you to a calendar year.
Yeah, we've noticed that if people don't file those fiduciary returns for 2 or 3 years, then they come in and want to file the return, at that point they're stuck with the calendar year.
Yes.
So you want to make sure that you stay on top of that and make those decisions early. Let's talk about allocation of income and expenses. That first year is very tricky as we end up the tax year for the decedent's 1040 return and start the estate return. We have, the brokerage houses are going to be issuing 1099s,
Yes.
that says that you made dividends of, $100 during the course of the year. And they're going to still show that very likely under the Social Security number of the decedent. Talk a little bit about those challenges.
Yeah, the accounting and record keeping is the biggest issue that we typically have, and certainly with any states with varied assets. And with the line of demarcation being the date of death, it's so important to get a handle around all of the assets and to start to properly allocate and get the income reported under the right tax identification number.
Okay. So early on, we want to make sure we get those things switched over and at least recognize if we haven't done it, that it needs to be addressed. There's a lot of people use revocable trust nowadays. Okay, so how does revocable trust and whatever's in that trust get reported when someone dies and we have an estate too?
Yes.
Okay, so is there anything we can do to kind of simplify and not, because that revocable trust becomes irrevocable.
Yeah, absolutely.
It has its own tax ID number.
Yeah.
So is there any options there to simplify things for
what
people?
can happen and the complexities that can arise there is that You've got assets, some might be covered by the revocable trust that is now irrevocable, and there could be assets outside of that. And under that scenario, you could be required to get 2 tax identifications numbers, one for the trust and one for the estate, and have 2 filing requirements. So the IRS does have an election, and of course it's irrevocable, where you can combine those and file one consolidated 1041 fiduciary return.
And that's important to note because the trust tax return period, the tax year for a trust, is going to be calendar year, whereas an estate can have a fiscal year. So if you don't make that election, you may have you have different years and different reporting. You may be filing tax returns all year long.
Yes.
If you don't make that election. So that's a good thing to know. That actually is IRS Form 8845 is that form we use to go make that election.
Yes.
Okay, good. Now, as I mentioned at the outset of the show, the reporting process and some of the way things are handled from a deduction standpoint are very different in an estate than they are for a personal tax return. And one of those things is this thing called the distributable net income deduction. So tell us what that is in simple layman's terms.
Yes, distributable net income, it's very similar to if you have a pass-through business, like a partnership or an S-corp, where the income of that business passes through to the owners. In a estate scenario, the estate can elect to pay distributions to the beneficiaries, and that income will flow through and be taxable to the beneficiaries.
So the important thing there is and the reason for that's important is that when we look at the tax rates, if the estate does not do that, the tax rates for the estate, we get to a much higher marginal rate quicker than if we do than the individuals do. And so there is a big tax advantage to passing that out. But there has to be some net income in order for that to work. So now, if there are losses in the estate, those losses don't get passed out during the initial part of the estate administration. Is that true?
Yes, yes. Typically speaking, on the K-1 from the estate, the fiduciary return, there's typically no negative numbers, no losses passed through until the final estate return is filed.
Okay, we're going to go back and talk about that.
Yeah,
That can be
it's
an
a little
important
complex.
thing. Now, there's another rule that applies to a fiduciary tax return filing, and that's called the 65-day rule. So that, what does that mean? What is that?
Well, it's a little bit of a grace period, if you will. The IRS recognizes that an individual having to deal with all these matters and all of the emotional and other factors that come into play and dealing with relatives and so forth. The IRS will allow you 65 days after the fiscal year, calendar year, whichever you elected, to distribute income and so forth so you can pick it up in the prior year as if it was paid. So if you have an estate that you projected there was going to be $30,000 of distributable net income and that's what you distributed, and there was capital gain distributions or something you didn't anticipate in the investment portfolio, you can pay that amount out in the 65 days subsequent to the calendar or fiscal year you're filing under and count it in that year's return.
Are you telling me that there actually is provision in the tax code that indicates the IRS has a heart?
Every now and then. Every now and then.
They're sensitive to family situations?
Absolutely. And
that's really enlightening.
Yeah.
Well, I guess the key thing to take away from the 65-day rule, though, is that it's a way to do some planning, and it may very well be that you want to marry up some of that income with expenses, so that you can get it, and you don't have to get it all captured in that tax year that you have. So that's a very important tool. Again, I have to ask that ever popular question, though. Now we're on the fiduciary tax return. I've got a bill from the funeral home. I write a check for that out of the estate. Can I deduct it on a 1041 tax return?
Not in the fiduciary income, not in the 1041.
Okay, so once again, we cannot deduct funeral expenses. This is getting to be a pattern here.
Yeah.
Let's talk about the challenges of the final 1041 tax return. Okay, and of course the 65-day rule will be especially helpful. At this point, we've incorporated all these rules into our thought process. Tell me what's really peculiar about the final tax return that's different from some of the other tax returns.
Well, the final tax return, that's the return in which you get to pass out if there were any capital loss carryovers, rental loss carryovers, and any sort of negative amounts that could be passed through. The IRS doesn't allow them to be deducted in any intermediary returns, but in the final return.
Okay. So that's something where we do see a lot of times that estates where there's going to be fiduciary compensation, that frequently will be held towards the end.
Absolutely.
And then deducted on the final return. That can often be a large number, and that can create a very big loss, which provides a tax benefit. I know I had one where we must have passed out maybe $80,000 of losses, but largely were because of fiduciary deductions for fiduciary fees at the last return. So it can be helpful, but it does require some thought along the way, and make sure you don't start writing those checks indiscriminately. Well, we've covered a lot of stuff here, Mark. I mean, the final 1040 tax return, the initial 1041 tax return, the final 1041 tax return. We talked about selection of your tax year for the estate and how that can be used. We talked a little bit about, the election to maybe incorporate the revocable trust, which is now irrevocable, into the estate return so that we don't have to file multiple returns and completely make ourselves crazy.
Yes.
Okay. A lot of stuff here. Okay. Some final thoughts for people about all these returns.
Well, the most important obstacle that we have faced being the tax preparers is the accounting records and having good records and evaluating the assets at the time of death and having an appropriate allocation. And we talked about deducting expenses in the return, and if the estate has tax exempt income, there's got to be an allocation of the expenses between taxable income and non-taxable income. And we've talked about funeral expenses. We find the IRS obviously looks very closely at where and how they're being deducted. And the medical expenses are also important because those can also be deducted in the final individual income tax return filed by the decedent. You have a year to deduct those medical expenses.
Okay.
So you have to take a look at all of those factors, and having a good accounting of the records is typically the biggest obstacle for individuals having to carry out their fiduciary responsibilities.
So the good records that you're looking for as a preparer, of course, is to get those accounts set up correctly from the beginning.
Yes.
To be able to understand, what deposit is from, so you can understand properly and account for it appropriately. Make sure that you bring in the appropriate 1099 so that you can get those allocated in that first year. In the year of death is especially critical.
Yes.
And I assume that you probably begin to notice that the tax ID numbers haven't been changed on accounts, and send people back to get those changed with the brokers or the banks, so we don't have to continue to explain to the IRS that it's not the decedent's 1040 income anymore. It actually belongs to the estate. So a lot to cover there. Well, Mark, this has been really very informative. And again, as I said at the outset, whenever we talk about taxes, people's eyes start to glaze over. Some folks may head to the liquor cabinet. I mean, it just becomes a very, very challenging situation. But you've really boiled it down into simple layman terms I think that folks can understand. I know I've learned a lot just from our conversation. So thank you very much for taking the time to do it. It's a great public service. And again, thank you so much for taking the time to talk with us.
It was a pleasure.
Taxes may not be the most interesting and spellbinding topic, but it is something that you, the executor, has to deal with in the course of the probate train ride before you elect to make distributions to the estate beneficiaries. As the show today highlights, there are a number of tax decisions to make, and these decisions have consequences. While we hope to educate and empower you as an executive with information from the Probate Nation shows, this is an area where you really need to seek out professional assistance, and we strongly advise that you do so. And that assistance should be from someone who is familiar with fiduciary income taxation, as many of those rules are unique and very different from the personal tax rules that you will use to report on your 1040 tax return. This brings us to the conclusion of our show. We hope you found it helpful. Replays of this show and all the shows broadcast to date, along with other helpful information, can be viewed on the Probate Nation website. On behalf of the Probate Nation, thank you for visiting with us.